what is a successful entrepreneur? I'm trying to think of what a definition is and how one defines not only an entrepreneur, but a successful entrepreneur. So I went to the web, just like you said. So here's what Webster says, right? The dictionary. An entrepreneur is one who organizes, manages, and assumes the risks of a business and managing that. Or so then I said, well, what about success? How many would define success if you make a lot of money? What are the other definitions of success?
Help a lot of people and
Yeah, go ahead. Just a couple, just one, how about one word definition of success?
Impact.
Impact? Pain? Fame.
Beating your goal.
Beating your goal, whatever that might be in the back.
Achievement.
I'm sorry?
Achievement.
Achievement?
Yeah.
Okay, thank you. Legacy. Very interesting. So it's not just wealth. And I love your comment about passion. Because do you think Steve Jobs did what he did to make money?
No.
Or is that a byproduct? I would argue it's a byproduct of a passion that was something much greater at the end of the day. And so each of you has to define what success is. And I would argue that it's in the eyes of the beholder. And so I can't define your success. You can describe it to me, and my success is likely going to be different because our objectives in life are different and our experiences are different. So, let's see if we can. In the venture capital description, let me give you my definition. It's the top 1%, right? We're hearing about the 1% club. We're into the economic equation. And so make no bones about it, venture capital is set up to make money. That's how we stay in business, is we try and find those individuals who are going to get to the 1% club on a frequent basis. Now, you have to decide what type of entrepreneur you are. Has anyone ever heard the pig or the chicken breakfast story? If you've heard it, yeah, go ahead. What's the difference between the two, right? Most of you have probably bacon and eggs for breakfast, and so what's the difference between the two? I'm not sure if that's on or not.
Don't put the poor girl
Okay.
on the spot now.
Who's more committed, the chicken or the pig? Who's more committed to that breakfast?
Pig.
The pig. He's all in, right? He got slaughtered for the bacon. So all in is how we define entrepreneurs. No rock left not flipped over. How about rich versus king? How would you think through that? King has the power. Does the power tend to bring in others who might manage his kingdom, his or her kingdom? Probably not. What happened to Facebook, right? Effectively, Mark brought in somebody else and said, I'm going to give you the operating role, the chief operating role, Cheryl. I want you to run that. That is not my experience, my current expertise. Right? And that's okay to be king. There's nothing wrong with it. But it will take you longer to get to where you want to go. And again, it all depends what type of business you want to build. There's no right size other than what you want to do. Visionary, I would argue everybody who's an entrepreneur has to either have vision themselves or access to it right close to them, hopefully on a founding team. Because you have to see what holes are in the market and then create a solution that meets that need. Naeem, I think you did a great job of focusing on that. You've got to really look at the market needs, so you have to understand it. You have to have a vision for how it plays out. Because when markets slow down, unless you're the dominant player, somebody else will come along. Either bigger guys will come in and take your position, or a fast startup may displace you. Ultimate salesperson, with your startups, who did you have to sell and how often?
Everybody, all the time.
What more do you need? I mean, you're selling everybody, right? Your customers, people to join you, suppliers, dealing with the startup. All those are really difficult things. The bank, right? You even want to get a loan from them. You're selling them. So salesperson, you do have to be the ultimate salesperson for your vision and your company. You talked about team building and recruiter. Boy, is that critical. The fog. I love your fog analogy, right? Because you don't have all the facts. That's really hard for a lot of engineers in the Valley. That's really hard. But the ambiguity that you have to live with is huge. And not making a decision, in my book, that's making a decision. You can't tell your people, I need more data, let's spend another 6 months. You can do that if you're Cisco, right? Not too many entrepreneurs are probably still at Cisco. And it is a marketing machine, marketing and sales, right? It's a great organization, but it's not an entrepreneurial organization anymore. And you got to be a problem solver and be realistic. You have to be optimistic but then a realist. We talked a little bit about that, and I'll talk more about that in a few minutes. What's the number one failure mode that you've seen, either of startups that you've been in or others that you've seen, especially through the business school?
One reason, they run out of money.
It's true.
No matter everything else, we run out of money. People, that's the only reason you fail.
And that's why I'm going to focus on it in my topic. And again, we didn't coordinate our talks here, but it is capital, right? Some people say it's the mother's milk. It keeps the young startups growing into something, into an older child over time. The timing, the needs, you spoke about that. Execution, you may have the right vision, but there's countless bodies, dead bodies of companies that were there at the opportunity first, but then didn't execute correctly. Business model, we spoke about that earlier. Sometimes it's mismatched with the opportunity. Changing the regulatory environment or reimbursement. Anybody in the medical area, medical device? I mean, that's a big issue. We do investments, we make investments in that area. That's a big issue right now. And then overly optimistic. What happens when you're overly optimistic? And it plays into the first bullet point. Do you sort of, before you have a solution, might you hire a couple salespeople and then start a marketing campaign? And what does that mean? You increase your expenses. And before you have revenues, that can lead to a very dangerous situation. We deal with that a lot in our companies, right? Because they're so optimistic, but sometimes they're not realistic in where the market is. Okay, notice I put V in capital. The critical success factor is capital. Most of you probably understand the different areas. Let me go through them real briefly. Entrepreneur savings. When you have especially internet-based companies, low barrier to low capital requirements, you can get up and running. And you'll see a lot of entrepreneurs, it's back to that pig story where you're all in. And so we look to fund startups. We love it when the entrepreneur has invested a lot of his or her money. Friends and family, with your startups, have you ever gone that route, or what are the strengths of that, and then what have been some of the challenges about that too?
In the very beginning, when nobody knows who you are, the only people who will give you money, who love you, who you are. So friends and family is usually the source for the very first 10,000, first 50,000, first $100,000. Because you need to have something before investors will come in. So that's always a source. If it's not friends and family, then it's your own savings.
That's right. The one change in the funding market recently, which I think is quite healthy, it's been angels for many years, but this whole crowdfunding. Has anybody heard much about this? There's quite a few different startups that are being created. Now, it might be, 10,000 to 100,000 or something of that nature. That's probably the sweet spot. But what I've heard from several of those individuals is a lot of the friends and family who are making those investments throughout the United States, and it just gives them a more organized source, an organized way to make the investment, because there's sort of a third party that helps structure it.
There's also a big new deal about the Jobs Act, which was passed only last couple of months. President Obama signed the Jobs Act, which makes it much easier to raise money from normal people. Before, you had to be an accredited investor, and there were all kinds of limits that you cannot have more than 500 shareholders. So now that limit has changed to 2,000, and it's been made much easier to raise money from crowds. So this is very important.
Yeah, and that's an important point. I met with a crowdfunding company recently, and in particular, they mentioned that it's going to have a significant impact on their ability to raise money for companies. Customers. I'm shocked at, or potential customers, I'm shocked at how few entrepreneurs will go to some of the people they know and say, why don't you give me some advance payments? Because you can't get the solution anywhere else. And why don't you give me insights about what you want? And especially if you get maybe a couple customers, wow, you get to keep 100% of the ownership of the company up front, right? When it's hardest to raise money and you have to give the most amount of the company away. But not enough entrepreneurs do that, which has always surprised me, but the smart ones I've seen do a great job. Commercial banks like Silicon Valley Bank, Comerica Bank, they've got certain programs for entrepreneurs, especially those maybe who they have had some experience with before, but they're being very aggressive. Corporates, especially in some of the drug fields, pharma, and corporates do want to support entrepreneurs and have active programs. Sometimes they do it through universities. So for those of you who are looking at taking technology out of UC Berkeley, or I spent a lot of time at USC, Southern Cal, there's actually programs where you can get money there, and a lot of times it's the corporates who put money into those programs, or corporates will invest directly in companies. And again, sometimes they'll just give them some money that won't go into equity, or sometimes they will say, we'll give you some money, but at your next, when you do your first financing round, just make that part of that financing event. And then the last is the venture capital. Now, there's not a lot of venture capital funded companies in the U.S. I don't know what the current number is. It's probably maybe 6,000 or 7,000 that are active. So it's a small percentage of the market, but the difference is it's highly visible. And so that's why all of you see it, and you live here, so you read about it on a daily basis. So I think it's helpful to understand, well, how does the venture capital industry work? So if you go up to the top, so we go to investors, institutional investors, and we say we're raising a $200 million fund or a $600 million fund or whatever it might be, and they say, great, and they give us that money for 10 years. And they don't have any say over what we do other than the business plan that we presented to them up front, which says we're typically going to invest in these areas, these industries, and we're going to make early stage investments or late stage investments, and we're going to invest in China or in Europe or US or wherever. And then the venture capitalists take this money and we invest in companies, but we invest in people. Go back to my earlier comment, we're investing in people who are creating businesses. Sometimes there's no revenues, sometimes there's no product, sometimes there's only two guys, and sometimes there's a dog. But then entrepreneurs will work to build value. And if you see the dollars I have here, so we get a certain amount of money, and our goal is eventually to liquidate all our holdings where we return to our investors at least 2 to 3 times the money that's been given to us initially. So this is a high velocity of a lot of money. Now, entrepreneurs looking at the venture capital community, is that something you think that's not understood? Or is it kind of hard to decipher what is important to venture capitalists and what are not?
I find, being on the both sides, most people don't understand why venture capitalists work. And they don't understand the model, and it will serve them well if understood. For example, if you go to a restaurant at 11:30 p.m., they'll seat you. But they're going to try to hurry you out because at midnight the kitchen closes. So they'll be, okay, fine, and okay, should we be going? Let's check the table. Same thing with a venture capital firm. It's a 10-year partnership. If you come to them in year number 5, they have 5 years left, they're going to hurry you up because they have to close shop. After 10 years, when they started, they have to sell all the companies and return the money. So you may have a perfectly great idea, but just doesn't fit their timing. And a lot of entrepreneurs don't understand the nuances, and they get all disappointed and freaked out.
Yep. So a venture capitalist is actually the entrepreneur's customer, and vice versa. And that's why it's important to understand these criteria that venture capital firms have, because they're all different, right? My background is different from another venture capitalist background, so I'm going to look at things differently. And I went to my investors, my limited partners, and I sold them a certain business model. And so there's that whole ripple effect. So you really have to understand each venture capital firm that you go to, because we're all different, even though it sounds like venture capital is the same thing. So, So let's start here. There's different stages, right? Seed, early stage, so first money in are pretty close. And during that, the key assets that a company would have, the entrepreneur, the vision, the passion. So they've got an idea. Sometimes they have technology. In our businesses, they have technology for those venture capitalists who invest in retail concepts. They may have a different business model or things of that nature. So it's not always technology, but in general it is, because there's discontinuities in technology more often than other industries. Second stage is kind of development stage. It means now you've got a team, you've got a strategy, a business model, you've got proof points, you have initial customer traction, and so you may, depending on your model, you may have like 3 to 5 large customers, or you may have 20 million individual users who are using your service on the internet. There's a lot of different, this is a big middle gap, and sometimes this is hard to find financing for this developmental stage, because you have to go through and demonstrate enough value so you give confidence to those investors in the middle that you're just about to scale. And when you're scaling, you sometimes raise expansion capital, and it's pretty predictable. People who invested in Facebook right before it went public, they had financial metrics. They could tell what the customer acquisition costs are, right? They could tell how much it costs to operate. They could tell who all their partners are, Zynga and others, and what they were generating. So then it becomes much more predictable. These are financial investors who are in this area, and the seed and early stage investors, they have to be visionary. because all you have is an idea, and they have to believe in your idea. So there's different skill sets that are here, and then down below, just, we talked a little bit about different stages, industries. My firm invests in medical devices and information technology and the intersection of the two. But if it's clean tech, we're not very smart about that. We don't really understand that market, so we'll leave that to others. Geography, a lot of venture capitalists locally will only invest to where they can drive in a day and back. And then clearly you might imagine some firms only invest in software as a service business models, for instance. And if you go to their website, you'll see a lot of this information. Sometimes you have to decode it, but it's pretty straightforward. Because we create our teams, our investment teams are geared towards these two line items here. Stage, industry focus, etc. We have skill sets that are geared just towards that. And then we also look on the flip side, and I'll talk about this, and it's something you need to look at, is what networks does that venture capital or venture capital firm have? Do they have any resources beyond just money? Because if it's money, you can go back to others and get that. But if you can't find that the venture capitalists and their firm has expertise, resources, would be good to have on the board of directors, because sometimes in venture capital firms we have operating partners who can come in and help take a temporary role until you hire that full-time person. Also recruiting, I spend a lot of time recruiting people, even individuals who my entrepreneurs don't know about, but I try and look out and say, okay, when are they going to need a VP of marketing or other people? I get involved a lot. And so with venture capital firms, any general comments relative to that?
No, I think this is an important point, is that, first of all, only 2% or less business get funded. Most of them are bootstrapped. And even the probability of getting funding from VC is very small. Not everybody needs VC funding. You're doing interesting apps or mobile apps. You don't need VC funding. So very few of you will be required. If you're needing to raise, less than $1 million, VC may not be the right answer. So this is when you need 3, 4, 5, and maybe more money, then VC is the right answer. So do some research. What kind of things they invest in? What size of investments do they make? Who are the partners? Where they went to school? What are the investment? Be prepared. Do some research. It's so easy to do now with the internet. So many times people show up in David's office who doesn't know anything about him. How is he going to remember them versus the two guys who had memorized his bio and knew that he went to the USC and played football with O.J. Simpson?
That's right. He was before my time. No, but the other thing is, to gain access to most venture capitalists, it's a referral business. So there's a wonderful law firm that we're in, right? It's going through accounting firms. A lot of them have relationships, and the number of companies that actually get funded of entrepreneurs who just show up at the doorstep and say, here I am, here's my plan, or send an email, and there's no connection. I mean, we probably fund 1 out of 1,000 deals that we see is the reality each year. And so it's a huge funnel, and it's helpful to have others do a little vetting, because then we help ensure that the meetings we have are productive. So this is a busy slide, I apologize, but it partly answers what venture capitalists are looking for and what entrepreneurs should be looking for. So let's just start at the top, okay? So what's really important is that entrepreneurs, senior management, and venture capitalists get aligned on where they want to take the business, especially initially. Now, we know we're going to bob and weave. Each business when we started, usually bobs and weaves, maybe at least 2 to 3 times, if not more. But we try and gain alignment up front. So some of the things that company criteria that we focus on in our venture capital firm, right? This is, do we believe in the entrepreneur? Is he optimistically realistic? That's important, right? We go after large markets, so go back to that. If we want to turn, our funds tend to be about 200 million in size. If we want to turn that into 600 or 800 million, and we've got roughly 20 companies that we invest in, you start to do the math. And if we own 20% of a company when we exit it, you start to see that we're looking for companies that will be valued $250 million to $1 billion to several $1 billion. That's the venture capital game. And most businesses cannot scale to that size, is the reality. It's the reality of the situation. So we look for large market opportunities. It's usually $1 billion or plus. Because if you want to build $1 billion company, it's better to start with bigger markets than smaller markets. Now the timing is important, especially if it takes too long for markets to develop. That's not good for us, because then it gives the incumbents time to catch up. So we need opportunities where the markets scale in sufficient time for our entrepreneurs to build companies around that. We also need them to develop before our companies run completely out of cash, right? And so there's, we make timing bets on markets. We also make IP bets. We invest in, can the entrepreneurs build it? And then will people come when they build it? That's my translation. First mover advantages. We talked a little bit about this in your distribution slide 9, and it's, what makes unique? What makes this company or this entrepreneur unique? What are they trying to do, right? Is it patents? Is it just intellectual property that's embedded in products or in solutions? Regulatory approval for those who are in those market spaces? And then the distribution, that can be an important differentiation, especially if you have a new product or service. Competition, you'll always have startups. And the great thing about Intel is, what's your saying? Only the paranoid survive? Something of that nature, and it's really true. You've got to believe you're going to have startups and established companies coming after your markets if they become large. Business model. There's a tremendous number of different business models, and so you have to get alignment between the funding sources and the venture capitalists or any individual who's going to invest, because you can have more capital-intensive business models and less capital-intensive business models. And there's not necessarily one best one. It all depends on the situation and the market needs in particular. In looking at, we look internally, so I think the question was asked earlier, how do we make decisions, right? We also look internal, and we say, if it's just money that the entrepreneurs need, we probably shouldn't invest in that deal. We should go on to the next one, because we want to add value, quote unquote. It's an overused term, but we want to find how we can give our startups a competitive advantage and others a competitive disadvantage. So it could be relationships that we have. It could be people that we can bring to bear. It could be corporate relationships. I spend a lot of time meeting, with a Cisco, IBM, or others, because one, we want to see what they're doing. Two is we want to plug our companies in. We want those corporate people to know about our companies, because one great way to take capital out of a startup's requirements is to establish distribution early through those who have already built the sales and marketing. So we talked about the example with Cisco. If you can plug your product or service into Cisco, wow, you don't have to hire all those sales and marketing people. That's really expensive. And there's very few companies that have a competitive advantage in sales and marketing. And if you have a new technology whiz-bang thing, you're probably not an expert in sales and marketing. You are maybe in defining that solution and creating that product or that service. But give that sales and marketing to somebody else. If you want to, you can always bring it in-house once you're generating profits. And also, many times those companies become acquirers of startups, of private companies, venture-backed companies. So that's why you go and you just don't get one partner, you get multiple partners. So there's multiple people bidding for your company. If if a company approaches you about acquiring your company and you've got multiple partners, then they already know about you. They already know how customers use that solution. So that's something that's really important to my firm. Clearly, how much capital goes into the investment? What are the risk points along the way? So for instance, if you're starting a new Cisco router competitor, the first step would be, can you even build the technology? So we fund companies through the first phase, building the team, getting the router in the market. Then we would fund it the next phase, once that's complete, for can they be successful in the market, right? So we fund it in steps. We think about how do we exit. I mentioned the distribution relationships, but we think about if we're a 10-year fund, which most venture capital firms, our funds tend to be, they're structured for 10 years and they usually go 15 years. We won't sort of talk through, that's a long story, so we won't go through that tonight. But we think about, okay, is it going to happen in the time frame of our fund? We think about the industry structure. I love businesses and markets where there's a whole lot more buyers than there are suppliers of solutions. That to me is great. I try and find environments like that because it means that if we ever decide to sell the company, there'll be more buyers than suppliers of that solution. The last, and we talked about this, is does the investment meet up to our stage? I think you have to flip this as an entrepreneur, right? Because if you can't find investment organizations where you can leverage their resources, or that you can't have a discussion around strategy and business model and things of that nature, I would continue looking for capital. Because while capital is not in great abundance, capital can be found. It's hard to find people who can be business partners with you, who have been there and built a lot of companies before, and they know the nuances of your market or the dynamics that you'll face in building an organization. It's great to have people like that. So whether it's a venture capitalist or advisors who can help you think through that, they've been successful. There's a lot of successful entrepreneurs here in the Valley that have now retired, doing angel investing, things of that nature. Those are the types of people I would seek out to have on my board of directors, my board of advisors, things of that nature. Because if entrepreneurs get that in the beginning of a company, then there's a lot more credibility with institutional funding sources like my firm. I mean, any thoughts relative? This is a big topic area.
It's a big topic, and maybe we should also, we're going to bring our entrepreneur up here in 5 minutes. But I think one thing I was going to say, suppose you approach an investor and you say that I have Larry Ellison and Bill Gates and Angelina Jolie on my board, and let me tell you what we do. He doesn't care what you do. If those people are on your advisory board, he is in. Now, I exaggerate by the names, but in your industry, there's some people who are well known, whoever they may be, If you can convince one of those people to be on your advisory board, it completely changes the profile of this company plus the 7 other companies he talked to you that week. So getting the right advisors on your board, even if you mentors, changes the profile of the company. Huge benefit with very little investment. Think about it.
Okay, so my last slide, and this is our elevator pitch, if you'll say, for Onset Ventures. So we're basically there to create billion-dollar-plus market opportunities. We get involved at the very beginning with entrepreneurs who have a concept, that idea that I talked about earlier. We invest in the 2 markets, in IT and medical, and the intersection of those. We like companies with deep intellectual property, so it's stuff that's hard to do, because that means it's more difficult for startups to quickly follow. So we fund a fair number of companies out of universities, and that's something that a lot of smart entrepreneurs do if they have a technology orientation, and a lot of people in the Valley do. You go find some pretty cool projects going on at Stanford or Berkeley or other major universities. Carnegie Mellon is down here in Moffett Field. There's a lot of smart people that are doing innovative work. They need other entrepreneurs to collaborate with and build companies. Capital efficient is all relative, but we do look how we can take money out of building companies but still build them into billion-dollar businesses. We love to collaborate with entrepreneurs, work closely on the board and in other means. I talked about the milestone investing. We've got a lot of people. As a venture capitalist, I actually look at myself as a resource of knowing lots of people to plug in and services to plug into our startups. So for instance, you don't need a CFO day one, right, when you're starting a company, but you need to know where to find those accountants or small accounting firms who can be that part-time CFO. It's one of the specialties that the Valley has. We have a lot of part-time resources who understand the drill. And it's one of the things that makes the Silicon Valley so powerful. Anyway, we've got a team of investors. We try and find the top 1% experts in areas. Investors, large institutions who you would know their names if I went through them. We've been around for 27 years. We manage about $1 billion. And we're proud of a lot of the companies that we've helped the entrepreneurs build over time. So do we go now to...
Yeah, we set it up for
maybe
the...
while we're setting it up, we'd be happy to take some questions.
Yeah. Okay, the young guy who's good at math.
Yes. So you've been doing it for 27 years in 6 funds, yeah?
Yes.
Does that mean that basically every 5 years you just start a new fund?
Yes.
It's overlapping fund. So fund is 10 years,
Right.
but it takes first 5 years to invest, and then they harvest, then start the new fund.
Right. So I was also curious, what actually happens to a company if they are still not at a stage where they've gotten acquired, if they've gone an IPO at the end of the fund? What actually happens?
It's a good question. And there's 2 things that happen. One, sometimes those firms will just continue to extend their fund until that company is finished. The other thing is there's a secondary market, so we can sell our position either to other investors or to new investors. So it's a good question, and it's...
They want to go home. They want to return. The limited partners are waiting to get the money back.
Right, because they have to, right?
Yeah, they have to. So they'll get rid of it somehow.
Yeah.
The gentleman in the back, Seva,
How much percentage of the company are you
to VCs.
Yeah. The one thing I didn't bring up, which I should have, is sort of the control issues. And that goes back to the king who are wealthy, and many times that's a trade-off. Venture capitalists need enough ownership to justify their time. And so you're going to see many times in the early stages, you know, entrepreneurs own 100% of the company starting out. Somewhere along the way, you'll raise funds through the early stages where you'll be giving up like half of the company or a third or maybe a third to a half, somewhere in that range. And then if there's a lot of capital that's required for big opportunities, then, you own less at the end, but you much rather own whatever percentage of Facebook than you would of a business that's worth $1 million. So this is where there's always a trade-off. How do you think about it as an entrepreneur now?
Yeah, I think you're absolutely right. I mean, the short answer to your question is 40 to 60% after Series A, 40% if you're famous, 60% if you're clueless, typically somewhere in between. And if you do 2 or 3 rounds of funding, founders may own only about 10%, 10 to 15% collectively, 1 or 2 or 3 founders. But hopefully by that time it's a much bigger exit. That's the short answer.
So when you say that only the 10% probably the founders will have, what about the angel investors?
They get squeezed out. They do worse.
Well, no, they don't get, the question is the whole pie worth more after you've raised capital? Because I would argue if the value is going to stay the same, you're just putting in more capital, but the value doesn't change. If it was, $2 million value of whatever to begin with, you raise $10 million, you put it in the company and it's still worth $2 million, there's something wrong, right? Those economics don't work for anybody. So what we're trying to say is if you raise that $10 million over the life of the company, I hope it's worth $500 million. And if it is, then maybe that angel investor who owned 1% to begin with, and they put in $10,000, now even if they own a very small amount, it could be worth $1 million.